Hey everybody, and welcome back to my little mini-series on linking performance to incentive pay. It's been a while since I did one of these. I actually haven't been on camera for around 6 months, so I'm back and I hope you like my haircut. Anyway, if you recall, in this series, I was exploring a slightly more advanced topic, and this was how you can link compensation, how we reward somebody, with their incentives for how they do their job. Usually this is applied to managers or executives, and it's actually taken very, very seriously in higher level circles because if you have a business or you own a business and you put someone else in charge of it, you want to make sure that they're going to do the things you would have them do. So exactly how you compensate them and how you pay them and reward them for various behaviors is paramount in determining how they're going to behave in the job. So we had done 3 of these before, so we are going to continue with part 4, and this is going to be a little bit of a shorter one. There's just a few points I'd like to bring up here. So just to try and get back into this, since it's been a while since the last one, here are 4 concepts that are going to apply to compensation and risk. So first of all, bonus bank arrangements. Under these programs, bonuses are held back for a year or more and left at risk, based on ongoing financial performance. Now, this is how they usually compensate a lot of managers, something that's they've found that works really well, and that is giving somebody a reward, giving them their pay, but delaying it, usually for more than a year, and it is still at risk if performance goes down, Usually this is tied to the performance of a business operation or something like that, We found that this actually really works, It forces people to think more long-term than short-term, and that is one of the highest priorities in doing this. Furthermore, unless someone believes in the highest gain scenarios, they are not likely to value options as highly as the market does. When you talk about executive compensation, invariably it's always linked to the stock market. It's linked to the value of the shares in the open market. And, they seem obsessed with this even when it doesn't apply, because the vast majority of companies are not publicly traded, right? But yet the principle of executive compensation is based off of, market value and things like this, And a lot of times this is used in the sense that the market is sort of used as a, how can you put it? A detector of public opinion, So if the management of an organization has a certain strategy and they make certain predictions and then they try something. They say, we're going down this path, and they announce this publicly, right? If the price of the shares falls immediately, that sends the signal that the public at large and the investors are not buying what you're selling. They're not sold on what you're saying. They don't believe you. If, on the other hand, you announce your intention to do something, and you say, this is what we've done, this is what we're going to do, and all of a sudden the value of your shares skyrockets, then this is taken to determine that the public and the investor community and the industry at large believes you, and they believe in you. They agree with what you're doing. That's kind of usually how the market is used in executive compensation. So traditionally, a lot of the way you compensate managers, decision makers, is their decisions are tied to the value of the shares. And this is under the assumption that the manager has the ability to affect the value of the company. They're like a CEO or they're a higher level manager, like an executive. If they're talking to the public, if they're doing things that are publicly visible, and it's going to affect the share price, either going up or going down, that's traditionally they tie that to how the executive is compensated, the value of their pay or their bonus, or if they're making essentially a cut of the profits. So So within that context, this is an interesting point, okay? If you're going to do something and you believe in the highest gain scenarios, you believe that the best possible thing is probably going to happen, okay? Then, you're usually in the market. That's usually how the market behaves. They tend to, it varies, but on the whole, they tend to look at the extremes, okay? Another point here is people systematically overassess small risks. Okay, this is market behavior, and that is why you can. Here's an example here. That is why you can sell them flight insurance, and why things like, I hate to say it, but things like nuclear power cause outsized concern. Okay, so people overassess these small risks when you look at their behavior. Okay. You look at statistics, you look at how often things happen and the impact of them happening, and you compare that with human behavior, and you see that human behavior doesn't really follow reality in those situations. Okay? So that's an interesting point, okay? And that ties in to how you assess the opinion of the market when it comes to deciding compensation, okay? And finally, this last point, which brings us back to the eternal theme of how you do this properly, is looking long-term rather than short-term, okay? Solutions based on total return metrics, okay, like total business return, the amount of capital generated by your business operation, okay? These type of solutions, okay, there are two main ways in which it serves the financial interests of investors. Okay, number one, by increasing the value of the businesses they own. Okay, so on paper, the value of the total assets or the total business value goes up. Okay, and secondly, the cash flow, how much money they're bringing in, how much cash flow they're generating. By generating cash flows from operations that can be distributed to them, which is essentially free cash flows. That's the other way that this benefits. Okay. But basically, looking at total return metrics is the way to go. Okay, you're looking at the entire value of the business, and you're going to look at this over long term. Okay, and that's what we're going to get into a little bit more on the next episode of in this series on part 5. Okay, but that's where I wanted to leave it here. Okay, anyway, these principles are basically applied to executive compensation. This is how we tend to get people to want to do the right things, to want to invest in the business rather than make a quick buck, okay? So hopefully that makes sense. Anyway, thank you very much for listening. You guys are awesome, and I'll see you on the next episode in this series. Take care.